Pick one sector for long term. One is defense and second is consumption.
See, in investment, it is very important that you buy in sufficient size, and it is also important to sell.
Any investment mistakes that you might have made in your career?
The biggest mistake where I lost 100% of money was that
when do people make more money, bull run or the bear run?
Patience on the right stock can give you money. Patience on the wrong stock can really lose everything. Ultimately, in the long term, the stock price follows the earning per share.
Hi friends, a lot of us are investing for our long-term goals. But do we really understand long-term investing? Do we know how to go about selecting the right assets for our long-term investments? To nail this down today, I am sitting down with Mr. Nimesh Shah, who is the MD and CEO of ICICI Prudential AMC. ICICI Prudential AMC is India's second largest AMC as of now. Personally, God has been really kind to me that I'm able to sit next to Mr. Nimesh Shah and talking about long-term investing, which is one of the topics that I am very bullish about. So with that, I'm sure that you are also going to learn a lot from Nimesh ji today. So Nimesh ji, thank you so much for giving your time. I'm extremely thankful.
It's very interesting to come in this new format of YouTube and how you guys are able to reach the right people in the country.
Thank you so much.
It will be good if I can interact nicely with your investors.
Absolutely. Thank you so much, Nimesh ji, because your experience, you've been with ICICI Prudential for 18 plus years and you have taken ICICI Prudential AMC to another level in the last 18 years. And for me and my viewers, what is really important is that we try and summarize a lot of your learnings over 30 plus years of your investing journey into almost 40-50 minutes of this conversation. So I'm really looking forward to it. I want to start with in media, everywhere, research articles. I read a lot and I find this one thing which is very common, that India is a long-term structural growth story. Why is it that everybody says that India is a long-term structural growth story? What are the top 2-3 reasons that I don't know whether you believe in that, and if you do, what's your view on that?
See, this particular topic is now done and dusted. Like for the last 20 years, we have been talking the same thing. So I always believe that India has got a great potential in terms of, because we are a very young country. And if we can convert the young people into very productive people, this country can really do well. So the potential has always been there since last 20 years. Since I had full hair, we have been talking about this. So the potential is huge. It is our ability to convert this potential into reality which will derive India. But suppose it does not do something outstanding or anything. Anyway, today we believe that a growth of 6% does not go anywhere. I'm saying, being conservative, I'm saying that 6%, so India will always give. There is 4% something of inflation.
Right.
So with a young demography, if this is what we can achieve, then you are talking about a 10% nominal growth.
Right.
You are talking about a 10% nominal growth in a country where there are young people, where we have potential. We have an industry which is spread across different segments. It is not restricted. We are not strong in oil, or we're not strong in telecom. It's not. When you look at Indian, any of the indices, they will have a very good mix of industries across.
Right.
That gives a lot of stability. The kind of flows that are coming into the country, people have the financialization of savings that we have been talking about since 20 years. If you see the last 10 years, it is actually happening. I'll give you a very simple example why of that. Is that earlier mutual funds as an industry was 10% of the banking industry.
Right.
Today it is 1/3 of the banking industry. This has happened in the last 12 years.
Right.
10 years back, it was only 12 years back, it was only 10% of the banking industry. So as a economy evolves, as a customer becomes more literate, right? Slowly he will go from traditional products to capital markets.
Right.
That has happened across the world. It is happening in India also. So a lot of structural right things are happening in the country. And this is the evolution of the country. So China had a great time between the last 30-40 years has been the China's time. If we are able to harness the young energy that is there in India, India is one of the few countries which is still very young. So if you are able to harness the energy of those guys and we are able to make the country productive, right, in a right way, then this country has got huge potential. It is up to us what we do in the next 10 years that will decide whether all the potential that we have been talking about is coming to light or not.
Right. Thanks for that, sir. And if I talk about the innovations per se, China and US have been leading, right? And they've been doing a lot of innovations, be it any sector we look at, tech or non-tech. I personally see that India is somewhat lagging behind. We are looking at productivity from population's perspective, which is great, right? That is definitely giving us a mileage. But there will come a point that innovation needs to be there, and I somehow feel that we are lagging there. Do you have any views on that?
Yeah, there are upside or downside, whichever way, whether we look at the glass half full or the glass half empty. I agree with you on innovation side, because we have our companies which are traditional companies,
right,
which are trying to come up, and maybe we are coming up with new companies also, but they are more or less doing a delivery or something like that. It's not that the cutting edge technology, we have done great job on that side. But slowly over a period of time, maybe the second line, but that point is relevant, that India is innovating less than the two countries that you mentioned.
Right.
These two countries have taken it to the, US was always there, and China has been definitely very, very impressive. We need to do better than what we are doing today as a country.
Right, brilliant. So moving to the capital markets then, I know our Honorable Prime Minister has been speaking about India being a developed country by 2047. From a capital market perspective, where do you see Nifty, Sensex? I know you're smiling now. You are not likely to give me any number. I know that. But at least from a CAGR perspective, what sort of growth you see in the next 15 years?
So I'll give you a very simple, the whole of investments can be put in a very simple term. Whatever we use, maybe people in the financial investor or investment industry use a lot of jargon. But for the common man, all that is not required. My ability is whether I'll be able to explain it in simple terms. As I said, that 6% is the growth rate of India. If you don't consider 7 and all, let's consider 6 and 4% inflation. 10% nominal growth of a country. Because of the phase that we are in, is that sustainable or not? It has been sustained over the last so many years. I think going forward also, these two realities are not going to go out. So we are blessed to be in a country. Like I'll give you a micro and we build up a macro.
Sure.
Right? You're blessed to be in a country which is growing at 10% per annum, nominal. Right? If it is growing at 10% per annum, businesses in this country can do better than that. Sure. Say when I look at my own business, I can do better than what is the nominal growth of the country. So when I meet people who are not into capital markets, and when I want to tell them that you should be in capital markets, I tell them that if you save, but if you don't invest, right, you are going to be poor. Right? 1 year down the line, you will be poorer than what you are today, because India is growing at this rate. If you don't grow, then the inflation will kill you. Right? So if you have to slowly, the younger generation, with a lot of people like you who are doing this good service to the nation by educating investors, we are getting new and new people inside capital markets.
Right.
So regular savings. Today, we are not dependent on foreigners. The capital markets in this country are not dependent on foreigners for sustaining where they are. Right? So foreigners are continuously selling, and we are continuously buying. So there is enough liquidity in the country.
Right.
Right. So it's both ways there is liquidity. So I feel that capital markets are well placed. If a country is growing at 10%, the top corporates of those country will definitely grow at slightly more than the nominal growth of the country.
Right.
Right. So if they grow their top line by 11 to 12%, then their bottom line can increase by 13 to 14%.
Right.
Right. So ultimately, in the long term, the stock price follow the earning per share. Right. So if the profits of if you see the last 10 years also, and if the profits of the companies have grown by 11, 12, 13%, similar growth, if we see, can happen in future because of the sheer fact that the country is growing.
Right.
So this I'm talking about base case, that we don't do something dramatically new, or we don't innovate and all. Those are the upsides.
Right.
But I'm saying, assuming no revolution is happening in the country,
right,
this kind of growth, which looks natural in this country because of the level at which we are.
Right.
Right. From there, having a nominal growth in this country and then riding, then should a common man should think that if he is in the investing for the long term, should he be in the capital markets or should he be in the traditional products?
Right.
Right. That's what they have to take a call. I think if we are, so capital markets in this country is growing. It is getting wider and wider by the day. If you look at the kind of industries that we have in the capital market today are very different from what we had earlier. If you see the sheer breadth and the kind of issues that are coming up, even loss-making companies can be coming into the capital market. So capital markets always looks good from a macro point of view, but your investors, I would say, be very, 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 very careful. People, the younger, the kind of products you go, capital market is growing, right? That will grow in India because India is structurally placed that way. How will you as a person benefit out of it? That the people have to think through. It is not an easy game. It is a knowledge game. Please gain knowledge as to, and please be aware of your limitations. How much do you understand? Ultimately, anybody who invests in capital markets, if you are doing a direct investment, you do direct investments, but you should know how much, if I am investing in a corporate, investing is what ultimately you're getting into the business of the corporate. You are a shareholder of that corporate, you are owner of that business, you are buying that business. When you buy shares, you are buying that business. Do you understand the business enough? Right? If you understand the business, definitely go. If you are in that area, similar areas you get into, if you are into, say, construction, and you understand the cement industry, and then you can envisage. I always tell people who are doing direct stocks that the capital markets in the country will do well, but do you have the expertise to understand individual stocks? Do you have the expertise to understand who this promoter is? What is his background? What did he do 20 years back? What did he do? Do you have the promoter's history? Do you understand that industry? Right? What are the industry dynamics? Right? Do you understand within the industry how the company is positioned? Will you be able to envisage 3 years down the line how much the company will be making? This process is the process that I'm saying is the equity research process.
Right.
So if you understand all these 4 variables, and then you should be able to understand the valuations, then looking at the future growth of the company, how do the valuations look today? If you understand all this, then get into direct stocks.
Right.
Otherwise, the capital market is growing. But I get very worried because of the number of people who are into options and futures.
Right.
That is the part that I'm really worried about. That they're coming into capital market. Are they coming in the right way?
Right.
And maybe our discussion should be focused on that India will grow, capital markets will grow. How does the common man benefit out of India growing and growing capital market?
Absolutely. I think that was my next question, and let's naturally speak about it, sir. So let's say I'm a middle class investor. I have a job somewhere, and I'm able to, let's say, save 5 lakhs a year, right? This is my hard-earned money, of course, and I want to make sure that I grow as India grow, and I want to invest it for long term, right? How do I approach it? There are various options. As you rightly said, direct stocks is one. Mutual funds is another route. We have got gold, silver, precious metals as another one. You have debt as an instrument. How a person who is a beginner wants to invest money for long term, and mind us that long term investing is very uncertain. There is going to be volatility. There is going to be, all of a sudden India's GDP is not growing at 6% or whatever. We hear in the news all the time. How do you then plan your long term investing? Where do you start from?
First, you start from how much volatility can a person take. Right? If I have been since the time, because I'm a firm believer that I have to beat inflation. And since the time I started earning, my first salary onwards, I only understood capital markets. I never understood any other instrument. So being a beneficiary of that, I feel that it is very important for the young guys to understand that they have to beat inflation. Otherwise, there is no point in saving. They are better off buying something rather than putting it in traditional instruments. That's what my firm belief is. So if you are into capital markets, if you want to get into capital markets, either you develop that expertise of understanding the companies that I said initially, that whether I would want to develop, whether I have the neck for it, whether it is there, or whether I want to learn that, right? There is a lot of material available online and one can learn that. I think investing can be learned. It is not a skill. It is not a skill that you cannot develop further. Right. So one thing is that along with your whatever profession is, I believe that when I talk to the next generation, I very clearly tell them that there has to be, one is your earning that you are doing with your profession, and another is investing. Right. Investing should be as important as your job itself. Because investing will make real wealth. And I have got this broad philosophy that for a young guy, you said young person, so a 23-year-old guy should understand, or a 25-year, that he will be working for the next 35 years. In this 35 years, you will have 5 booms. minimum. I have seen it in my career. There were 5 booms and 5 busts. There will be very, very irrational times. The boom and bust both are very irrational times. If you think you have to make serious wealth, it is your behavior in those boom and bust. When the markets are completely, there will be irrational exuberance at some point of time. There will be irrational fear at some point of time. A lot of guys, a lot of times feel that I should have been 10 years back, I should have started investing.
Right.
I would have made so much money. 20 years back, this was the opportunity. In 1990s, this was the opportunity. I am saying that every 2 years, every 3 years, you see an opportunity coming up. Right? It is up to how you capitalize on that.
Right.
You see new companies coming up and how you capitalize on that. I feel that fundamental investing is something that one can learn. One should have the interest in doing it. And if one wants to do it in 20s, it's a great time. One of the best way of learning investment is to form a group. Form a group of like-minded people, of people with similar skill set.
Right.
In that group, you don't have to have somebody who's a rocket scientist in investment. You don't need that. You need sufficiently inquisitive group of 5 people who meet once a month with some ideas.
Right.
Right. That really, that ecosystem, the ecosystem that you create of 4-5 people who have similar mindsets and want to learn, that builds, you learn from the experience of the other 4 guys.
Right.
Right. A formal meeting once a month and try to gain knowledge. So that is one way of gaining knowledge. Read a lot during the month and then once a month make a formal presentation to your friends as to what you learned in that, and they make. So your learning becomes 5 times more if you do that way. So create learning, and if one comes to the conclusion that I am not in it for trying to understand companies, or I don't want to spend my life trying to be very serious and trying to understand companies, it can be a choice also that I want to do other things in my life. Except my job, I want to do photography, I want to do hiking, I want to do many other things in life, and I don't want to spend my time on trying to understand companies. Then don't try to ask ABC, XYZ every second day that what should I buy, and then buy it. Because see, in investment, it is very important that you buy. It is very important that you buy in sufficient size, and it is also important to sell.
Right.
What people do, they keep on asking people rather than doing research, and somebody tells them something, they go and buy.
Right.
But since it is not your conviction, it is somebody else's conviction, you will not have made a concentrated bet on this one. Right? Then you don't make, even if you go right and it becomes a 10 bagger, you would have invested so less vis-a-vis your portfolio that it won't make any sense. It's not going to change your portfolio completely. So I feel that if one is that you do that kind of research, but if you don't want to do that research, a safer and a more thing is to go to diversified instruments.
Right.
By diversified instruments, it's not that I'm trying to package a mutual fund and sell a mutual fund to a young guy. But what do mutual funds do? They buy, in one fund, they will buy 30, 40, 50 stocks. So your risk is diversified because you don't know future. You think that you know the future, but most of the times, future is probabilistic. Right. One has to understand that one always does not go right. One takes concentrated bets also. One does not take concentrated bets because you want to diversify amongst various stocks. So the other route is that if you don't want to develop your own expertise, then go to a mutual fund. Right. I think this is a very well regulated industry. The best part of this industry is that the products are in the interest of the customers. Security and Exchange Board of India, SEBI, has been very, very vigilant, and I have seen this evolution since 2008. I think the product has become purer and purer for the final investor. Today, as a business, we may not be making sufficient money, but the product is very good for the investor. So margins in this business are very less for the middleman, for the distributor or for the manufacturer. The margins are very less, but that is the best part of this industry. Our margins are so less that it is the right product for the final customer. Right. So I think at a charge of say 1.5, 1.6% of the total, if the mutual fund is ready to do all the process that I told you earlier, set up research guys, the research guys will get into who is the promoter, what is his background, which is the industry, how has the industry been growing, what is the expectation of this industry growing further, how is this company placed in that industry, will this company also grow with the growth in the industry, can it outgrow the industry, how is the valuation of this company, Is it rightly valued or is it overvalued? Should I wait to buy or should I? So all this research has been done by the fund management company.
Right.
So with a reasonable charge, and SEBI has regulated those charges quite well. With the reasonable charge, if the customer is getting a good mutual fund, it is best to go and invest in a mutual fund, because you get a diversified instrument. You don't get one stock. When you buy one mutual fund, you don't get one stock, two stocks, three stocks, 10 stocks. You get 30, 40 stocks spread across different industries. So that's the best diversified instrument to get into. And then do your research well on how to buy that mutual fund, which mutual fund to buy, right? Any of the companies with a good track record is only for to know that the person is, some amount of research will be required to understand what will work well in future. So
right.
Focus on the future rather than the past, and then happy investing. That's what I believe in.
I think, sir, you touched upon direct stocks, and then you said that people, if they can do their own research and spend sufficient time, then of course that instrument might be for them. But then if people are not able to do that much research, then they should lean towards mutual funds. Even within the mutual funds, there are a lot of options nowadays, right? I mean, 40 plus, I don't know how many different types of mutual funds are there. How do you go about narrowing down? Because even, let's say, if I pick up mid-cap segment or small cap segment, there are 30, 40, good AMCs. How, as an investor, I go and look at those mutual funds and compare them?
So that can be really confusing. So one part I would say is that first thing, a person should understand how much volatility he can take. Before
right.
even going into which company and which product, it's very important to understand what volatility a person will be able to digest.
Mm-hmm.
A person like me, even in COVID times, if the market falls 50% and my portfolio falls 50%, I won't get unnerved. I'll peacefully sleep, because I understand what I've got into. I know there are temporary issues. It has crashed and it will come back again.
Right.
So, but if a person can I have seen people getting depressed also and having problems also when the volatility increases and their portfolio goes down. Unfortunately, right now in the country, people have forgotten that equity is volatile and it is risky, right? People have forgotten that. So one of our major need to come to your channel today is to again reinforce to the investors that the markets have an inherent risk. Equity investment or mutual fund investment is risky. One should beware, one should worry at what levels they are coming in and come accordingly. Right. So one is to understand how much volatility you can take. Depending on the amount of volatility you can take, you can decide your equity exposure.
Right.
Because equity in this country will be volatile. So there are various funds in the country which have got different levels of equity.
Mm-hmm.
They are called balance funds or balance advantage funds or multi-asset funds. These are categories which invest in different. So there is a category called multi-asset category.
Right.
What does multi-asset category do? It invests in equity, it invests in debt, it invests in metals also. Right. So whether they have got a view on gold, silver, they have got a view on debt, they have got a view on equity. So sometimes equity does not make return. Maybe metals will make return.
Right.
Sometimes equity loses money. At that time, the debt will cushion the fall in the equity.
Right.
So a multi-asset fund will have some levels of equity, but it is essentially an equity fund. So overall 65% is in equity. But there are funds even suppose I cannot take that much volatility also. I want more steadier return. Then I need to increase the percentage of debt in the portfolio. Right. So then I would go even for a fund which has got even lesser equity.
Right.
Say a balance advantage category, which might have some balance advantage fund would have much lesser equity. So keep on going to funds where your volatility levels, your ability to take downside is very important psychologically. It's a psychological issue that a customer's ability to take volatility, different people have different risk-taking skills. Right. And whether you will be able to wade through volatility. India ultimately is a growth country. As I said, we grow at around 10% nominal. So ultimately, markets, when your diversified instrument will make money.
Right.
Suppose you bought a single stock and that industry is over, or that industry has got serious problems, or that company has got serious problems, you can lose your capital also.
Right.
But normally in a mutual fund where you have invested in 30, 40, 50 companies, some of them will not do well, some of them will do very well, and some of them will do average. So on an average, getting the nominal growth of the country or the Nifty growth is not that difficult.
Right.
right? It has happened in the past and it can happen if one has. So now the question is, so more than which company you select or which category of funds you select. So if your ability of risk-taking ability is very limited and you would want a gradual growth, you have got some targets in mind, you have got your son's education in mind, you have got your target retirement planning in mind, then you will decide how much equity and how much debt based on what is the target. Once you decide on that, then there are various categories whether you want to be on the large cap space. Large cap space is more stable over a period of time. They might make slightly lesser return, but these are the big companies in the country, right? So they will not go off they might gain lesser, but they are more stable. So there comes balance funds, then there are large cap funds, there are mid cap funds, there are small cap funds of various companies. It's very easy if you go nowadays, if you go to the website of a value research or something, you get the ratings of companies. So there are many rating agencies. Go into the rating, they give 5-star, 4-star, 3-star, 2-star. 5-star means, so one is to understand your own objective, then go and select a fund, but one should understand that all these companies majorly look at the past track record.
Right.
The 5-star and 4-stars come based on past track record. So once you are going for a diversified fund, any fund which has got a good brand, which has got good people working for it, it should be okay to buy those funds.
Right, right. And Nimesh, within mutual funds, we also have two options. One is the active funds that we could select, and then you have passive funds, be it indices or ETFs. How does one decide which route is better for them? Because of course, both comes with their own pros and cons.
Actually, in India, that is not much of a debate right now, because active funds, overall active funds, one has to see whether the active funds that one is buying, what is the difference between active fund and passive fund? Passive fund is only tracking the index. Right. So there is something called as Nifty index or Sensex that your customers would have heard about it. So Sensex or Nifty, they'll take the 30 companies of Sensex. So if the BSE Sensex goes up 20% in the next 1 year, you will get 20% return. Plus or minus 1% here and there. You will get more or less how much the index is there. Index is nothing but a summation of 3 companies. Weighted average of those 30 companies will be the index levels. Right? So on an average, if those companies have gone up 20%, you will get 20%. If they have gone down 10%, you will get 10% lower. So you are not outsmarting the market, you are going with the market.
Correct.
Right? So that is what passive investment is all about. Active investment is that you want somebody to apply their mind. You are asking the asset management company that please deploy a fund manager who will think on my money and will decide the stocks which he thinks will do better.
Right.
So more or less, when you go and choose a fund manager who has got a track record of 10 years plus years, so who has seen various cycles, right? Actually, making money out of business is over 10 years, because on 10 years, you see various cycles.
Right.
You see the upside of the market, you see the downside of the market, you see the market not going anywhere. In all those phases, how that guy has done.
Right.
Right. So you will take a diversified instrument from a person, from a AMC, which has been managing that money for a long period of time. Right. Then you get sufficient confidence that this company has managed this fund for last 20 years. Right. And it has done well.
Right.
Right. So that is a safe way of selecting somebody.
Right.
To manage your money.
Right. Right.
For me, everything is the track record. Right. When you are going for a diversified fund, you are not taking a sector fund where you have to. Sector fund is where you are taking a call whether technology sector will do well, banking sector will do well. So for the common man, it is best to go for a diversified fund. Right. And invest for the long term. Right. So some companies in that fund will do well and some companies. So in India, I don't see a debate, at least personally, the way I look at it. I have my 100% of my portfolio is in active only. Right. I don't invest in passive. Right. Because for the simple track record, a lot of active fund managers have beaten the benchmark over a long period of time. Right. 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 So as long as fund managers are beating the index, we are into ETF business also, we are into active also. So as long as a fund manager is beating the index and so he's smarter than the index, why will I not invest with him? Why will I invest in a passive? Right. So in my mind, the choice between active and passive, I'll go for active because fund managers have beaten the index, and I'll go for a fund manager whose track record is to beat the index. Right, right. But if he does not beat the index at that point of time, I might think of passive. But right now, I'm not thinking of passive.
Okay, great. And Nimesh, you talked about your own investments being more towards active. Do you also pick up stocks for your own portfolio, or your?
No, I focus only on mutual funds because regulatory also, since I manage a mutual fund.
Right.
So I focus only on mutual funds.
Right. Brilliant. Okay. And you've been in capital markets for 30 plus years now, right? If you were to sum up, I think it's very hard to sum up anything that you have lived through for 30 plus years. But what would you say is the top 3 learnings, if you were to compress that into top 3 learnings last 30 years?
I feel that India is like an elephant.
Right.
Keep the noise away. Mm-hmm. We will always go 2 steps forward. We might come 1 step back. We will again go 2 steps forward. Where our direction, because of our democracy, direction is very clear.
Right.
We have been the beneficiaries of the reforms that happened in the 90s. Right.
Yeah.
So India is consistently, slowly. We are not in a great rush, but slowly and steadily we are in the right direction. And we are continuously improving. So in that environment, one should always be invested in instruments who benefits out of inflation. India always has an inflation. I will put a simple question: who benefits out of inflation? The businessmen benefit out of inflation, right? So if the businessmen benefit, either I should be in my own business, or if I don't own my business, I should invest with a business so that I can participate in the growth of the country.
Right.
That is the broad thought that I've always had, that though I am doing a job with ICICI, I would always like to participate in the growth of the country. Real wealth is made out of investing in the right way. Right. And that has happened consistently over the years. The way some of our funds have done over the last 20 years, if you see the way the funds do over 20 years, right? And remain invested. If the AMC that you have invested is good, if the and they are managing the money responsibly, only invest with people where you will not they have a governance structure where you will not have to remove it tomorrow. Right. So, and remain for the long term, right? And when you remain for the long term, you will get the benefit of this country's growth, this industry's growth, those companies' growth. You will not only, what we call in technical terms, when you invest in passive, you get the beta of the market. That is whatever is the market growth you get, plus the expertise of the company in terms of how much they do better than the market. Right. So that both the advantages that you get in India, and milk those advantages and invest in the right way. That's what I've understood.
Right. And what's been your core investment philosophy? I know you've spoken about India a lot. Do you prefer momentum, value, growth? What sort of your...
I don't understand at all. See, I'm not a short-term guy at all.
Right. Even from a long-term perspective.
I have invested, I've never gone out.
Right.
So there is no such thing as momentum in my life. I'm a fundamental investor.
Right. Okay.
Invest. There was years back, there was an ad of a bike which was giving a very good average. It used to fill it, shut it, forget it.
Right.
So my investment style is like it. Once I buy very solid institutions, mutual funds from solid institutions, and then I've never sold.
Right. Any investment mistakes that you might have made in your career?
The biggest mistake where I lost 100% of money was that I took the benefit of the scheme that the government has of investing abroad. Right. So of all countries, I saw Russia as a very value deal.
Right.
And I invested in Russia.
When was it, sir?
This was 5 years back.
Right.
And then it went up very well. I was very happy with my investment, and then I lost completely. So that was the biggest mistake I made.
Right.
And then also, it was not a mistake investing. Nobody could have envisaged that this will happen. I didn't remove, as soon as the incident happened, there were 2-3 days where I could have got out. Right. In my own style,
you're referring to the Russia and Ukraine war.
Yeah.
But that you couldn't have anticipated. And
that I could not have anticipated. But when this happened, there were 2-3 days where the redemptions in that mutual fund, that ETF that I had invested, was allowed. I didn't do that. So I would say that was the biggest mistake.
Right. So does that mean that,
how could have...
So I'm trying to understand, what is the biggest learning from
political risk.
Okay, geopolitical
risk which you don't understand. If an incident had happened, just get out at that point of time.
Yeah, okay.
Geopolitical risk is something that, it was not COVID times, where COVID will come and go, India will prosper, right? That was not a mistake of not getting out, right? That was you invest whatever I had, I would have put more. There is a difference between that problem, right, and this problem, right? In COVID times, In fact, when the market became half, I had to put more money in the market, right? Whatever I had.
But Nimesh, I'd just say that when COVID happened, I remember it, that when COVID happened, shutdowns happened, lockdown happened, there was no light in the tunnel. And it at the time felt, now because we are looking and sitting here in hindsight, we're looking at it and saying that, we could have put more. I remember sitting there and, worrying about the portfolio, and I said, you know what, world is coming down, because it's a very natural reaction. And
so my mindset is different.
Right, okay.
My mindset is different. I don't believe that the world will come down. Incidents will happen.
Sure.
Look at the last 25, 30 years. So many things have happened. There was 9/11. There was so many things have happened in the world, including COVID. Yeah, there was a disease, and it was very unfortunate. We lost a lot of lives. But when you look at macro, nothing changes much.
Right.
If India is a country which has lasted so many 1,000 years, if for 3 months the country slows down or closes down, it's not going to change the world. Right. So the market should not have become half because of that. Right. So that was an opportunity. So that's what I said. Now I told what I tell the next generation also, that in your life, there are going to be 5 huge exuberance and 5 complete dumps.
Right.
How you behave in irrational times is going to decide how much wealth you have in life.
And I think this conversation hopefully will reiterate the same point. And there is no other way to learn and control the emotions, just to continue to reiterate this fact that there will be tougher times, and it's how we hang on
so
to
Russia also, I thought the same. Okay. But geopolitics is something that you don't understand.
Right.
What I thought in COVID times, that this will come and go.
Right.
Same thing I thought on this one, that this also will happen at some time, it will open up.
Right.
But this is something which I don't understand.
Right.
Geopolitics is something nobody can take a bet on.
Absolutely.
So don't take a bet on things that you don't understand.
Right.
I took a bet. At that time, I took a bet on what? Did I have any basis to know that this war will get over? I didn't have any basis to know.
Of course not.
Right? COVID, I can say that India, I had a reason. I told you that 5,000 years the country is going to last it. So if the 3 months the country closes down, it's not going to completely finish the industry. The cement plant will work after 3 months, no? Right? And it will come back to houses will get constructed in India. India is not going to stop constructing houses. But geopolitics. So don't bet on things that you don't understand.
Right. Nimesh ji, let's now move to the rapid fire, my favorite section, where I'm going to ask you some questions, give you 2 options, and you select one out of it, right? So in stock market, what is more important? Is it the patience or the stock picking skills?
Both are important, because patience on the right stock can give you money. Patience on the wrong stock can really lose everything.
Right.
So I can't choose between the two. Both are important.
Right. Okay. Better long-term return generator in your view, stock market or gold?
Stock market, because it is a productive asset. The difference between gold is the best way in India to beat inflation.
Right.
Because it's also a hedge against dollar rupee depreciation.
Right.
The way I look at gold is beat inflation and beat rupee depreciation.
Right.
So gold is good, but stock market is a productive asset.
Right.
And I think it has generated more return than the gold market.
When do people make more money? Is it in the bull run or the bear run?
Because India, you don't know how to go consistently short. Bull run, people make more money.
Right.
The whole tide turns. The whole water level goes up. So everybody is richer.
Right. A lot of people actually believe that, like at least the one that are in my network, they say when it's bear run, that's where you put more money so that, you can reap the benefits whenever the bull run comes. But, I've seen both world as well. So,
the bear turning into bull market, then you make money, no?
Exactly. Until then, you just sit. Pick one sector for long term out of these 2. One is defense, and second is consumption.
Consumption. Defense industry in India is not that wide. Right. We have got all sector funds, but we have not come out with a defense fund.
Right.
The reason is there are not sufficient number of industries to run a diversified mutual fund.
Right. Okay. Your personal preference between momentum or value investing?
Value investing, no doubt on that. I told you earlier also.
I get this answer very consistently among many leaders from AMCs that they believe in value investing. Is there any particular reason?
In India, if you see, most fund managers are also, their style is value.
Which would generate more wealth in long term? Is it the large cap or the mid caps?
That depends at what levels of the markets you get into.
Right.
But there is something called as risk-adjusted return. I will not answer this. Why I am not answering this? There is something called as risk-adjusted return.
Sure.
Right? One should understand at what risk. What is the risk-adjusted return? What is the risk that you are? What is per unit of risk that you are taking to generate a unit of return?
Okay.
Right? That is extremely important.
Right.
So, what are the levels of the market today?
Right.
Whether is large cap, where is mid cap. So the current valuation levels are important, and the another important thing is that what will be the growth in those segments, and if there is a downside, which sector will be able to withstand it better.
Right.
Whether the large cap, suppose there is a another COVID or any accident like that, will the large caps be able to sustain? So the current issue with the US, will the large cap be able to sustain that better, or the mid caps will be able to sustain better? I feel in the world where it is currently, this answer will be different at different times.
Right.
Today, the answer is a clear large cap because there is too much uncertainty in the world.
Right.
Mid caps are anyway overvalued. So when there is uncertainty in the world, I do not want to go for mid caps and increase my risk further.
Right.
Right. So I would want to control my risk at any point of time. And with the levels at which the markets are today, I think mid caps are more expensive than large cap. That is why I'll go for large cap in an uncertain world.
Great. What's more important for you when you pick any company? Is it the promoters of the company, or is the business mode of the company?
I think my focus has always been on promoters. We can go wrong on valuation, we can go wrong on business, but we should not go wrong on promoters. In fact, especially for mid caps and small caps, everything is promoter. The bad promoter can convert a good business and be the most profitable guy in that industry.
Right.
Right. But if you are left with a bad promoter, nothing can happen. Even if the industry is good, the business is good. If he does not have the orientation of sharing his profits with the minority shareholders in a fair way,
right,
then there is no point in being in a good industry and a good business if the promoter is bad.
Right. Okay. For people in their 20s, what would you say to them? Work for money, because it's very important, early stage, you don't have enough money. So work for money or work for passion?
I think it's a very leader. Everybody will say the same thing. Even I'll say the same thing. That people in the 20s, if they're able to find where is their passion, and the passion should also be what the world values.
Right.
You can't have a passion which the world does not value, and you will be then it is a hobby. It's not a profession. So if you can get something which is your passion, which you are good at, and the world also values it, and commensurate returns can be achieved from that, that's the best bet to have. Right. We are very lucky to be in an industry where we were very passionate about. So then, after 32 years of working also, it does not feel like working.
Absolutely.
Right? If it is a huge problem, stress to go to work in the morning, then itself it's a problem.
Right.
So the good thing about getting to work or choosing work which is your passion is the best thing to do.
Brilliant.
And that it should be paying also.
Of course.
Right.
Of course, somebody got to pay the bills. On that very positive note, I've thoroughly enjoyed it. And thank you so much for your time. Any last words? Otherwise, we are good to close.
Good. We are good. Keep investing. Keep long-term investing.
Brilliant. Thank you so much. I hope you enjoyed this podcast. I look forward to see you in the next one. Until then, keep rocking.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.